This is Fintech Conversations with Flagship, a podcast production by Flagship Advisory Partners. In this podcast, we discuss the big topics shaping the world of payments and fintech, and each episode will bring you sharp insights and fresh perspectives from the industry. So whether you're building, investing, or simply just curious about fintech, you're in the right place. Hello and welcome to the very first episode of Fintech Conversations with Flagship. My name is Elizabeth Magno and I'm the host of this episode. We are Flagship Advisory Partners, a consultancy that specializes in strategy and M&A in the payments and fintech space. Today, we're diving into a very interesting topic, which is the financial health of public fintech companies. Over the past years, fintech has been on a rocket ship, growth everywhere, funding pouring in and headlines full of big promises. But here's the question we wanted to answer. What exactly lies behind the growth? Is growth powered by efficiencies? So are fintechs finding smarter and more automated ways of generating revenues? Or were costs secretly piling up in the background with ballooning operating expenses? That's exactly the analysis our team has been working on. And without giving away too much just yet, I can tell you this. The way fintechs manage their financials has shifted dramatically over the past 3 years. So in this episode, we're going to unpack what's really going on under the hood. But first, I'm happy to introduce the guests of this episode. First up, we have Joel van Arsdale, a truly impressive person. He's the managing partner and founder of Flagship. He has supported hundreds of deals across his career, and Joel's financial sponsor clients are among the world's most successful investors in fintech. Welcome, Joel.
Thank you, Elizabeth. Thanks for hosting the discussion, and we're excited to discuss this topic, which I think is a very interesting one. I think what the audience will hear is really dramatic shifts in how fintechs are managed as seen in the public markets over the last 5 years. And so we're excited to get into the details of that.
And in addition to Joel, we also have Ram joining this episode. Ram Massetti is a principal at Flagship, and he brings more than 10 years of experience in fintech and is considered a trusted advisor in domains such as CFO SaaS, B2B payments, and payments orchestration. Welcome, Ram.
Elizabeth, looking forward to exploring some of the key drivers behind the fundamental shifts and discussing how we see the market developing along some of these themes.
In this episode, we are discussing the financial health of publicly listed fintechs. The background is an interesting analysis we did now in 2025, which was a refresh of an analysis we did back in 2023, and the topic gained a lot of attention in our network. So Joel, before we dive into the data and specifics, appreciate that not everyone listening are familiar with our research. Could you please share some background on why we conducted the analysis at the time and what metrics we looked at?
Yeah, so firstly, Flagship publishes, 100 insights a year. One of the advantages of the fintech industry is that there are a lot of publicly listed companies, dozens of listed companies around the world and across different subsectors within fintech. This analysis specifically focused on 50 publicly listed fintechs. It was an analysis first conducted in 2023 using 2022 data. The reason why we conducted the analysis then is because we were essentially emerging from a valuation and exuberance bubble in the public markets and fintech equities. And so we essentially wanted to test sort of what was the management philosophy of fintechs coming out of that bubble or as existed during that bubble. And so we prepared a data set using really two basic KPIs, which we converged into one measure of performance index. So we essentially looked at gross profit growth between 21 and 22 in the original analysis that we published in 2023, and then more recently between 2023 and 2024, the analysis that we just published. We essentially measured gross profit growth over each of those time periods and then OpEx growth over each of those time periods. And then we created a simple metric that we call revenue efficiency, which is the gross profit growth divided by the OpEx growth. The reason why we picked this KPI is that fintech is an industry that should be delivering very significant scale efficiencies. And one way to measure scale efficiencies is just by measuring your top line versus OpEx growth, or top line versus bottom line effectively. And for you to be generating efficiencies, that number has to be above 1. And for you to be generating significant scale efficiencies, that number really has to be above 2. And so that's simply how we went about the analysis. We also took those 50 companies and we bucketed them by business model. So we defined them as either diversified processors, as merchant PSPs, as payment schemes or networks, as B2B fintechs, as SaaS fintechs, or as product specialists or other types of fintechs. And we did that just to understand if there were categorical trends within business models that were impacting the overall performance KPIs that we were measuring. So that's the basis of the analysis. I mean, we're using, a good deal of public equity data, but actually measuring efficiency performance or scale economy performance using one simple metric, a gross profit growth over OpEx growth, one being a baseline for your effectively generating no scale efficiencies, two being a baseline for generating significant scale efficiencies.
So to put it simply, you're comparing how fast revenue is growing versus how fast operating expenses are growing. And obviously, in ideal fintech's revenue growth should outpace expenses if you do it in an efficient way. And when you think about it, it's such a straightforward but really clever way to look at things. So Joel, in your recent research from 2025, this is an update of your 2023 analysis, which we rightfully gave the title, Higher Growth, Fintechs Must Now Learn Efficiency. So if we go back 2.5 years from today, reviewing that 2022 fintech performance, what were some of the key observations you made back then?
So 2022 was really the high water mark of exuberance in fintech valuations. And so this is one of the reasons why we went looking for these insights, is that we suspected that the industry had really lost track of focusing on scale economies and efficient operations. And that, in fact, is exactly what we saw when we went looking, which I'll explain in a minute. But essentially, fintech, went through an exuberance bubble. COVID really focused attention on the industry as the entire world sort of transitioned towards digital transacting and digital commerce as opposed to physical commerce. So fintechs, by and large, benefited significantly from a focus on digital commerce. And so all fintechs essentially achieved peak valuations in 2021, 2022. And so 2022 being the baseline of our analysis, we were essentially capturing the end of that exuberance bubble. And so what we saw was correspondingly not surprising. It really told us, in fact, that that's exactly where we were in the cycle, because when we looked at the data, what we saw was that over half of the companies had a revenue efficiency index of less than 1, meaning their OpEx growth, in fact, was exceeding their gross profit growth. And less than or only 15% of the companies had a revenue efficiency index of greater than 2. And so those were dramatically poor results, quite frankly, because it meant on average the entire industry was failing to deliver on scale economies. What's really impressive, though, is that the most recent analysis is really the flip side of that storyline, which is there's been a dramatic reversal or dramatic improvement, rather, in how fintechs are managed financially. In the most recent sample, in fact, the majority of companies were well above 1 in their revenue efficiency index. Greater than only 21% of the sample of 50 companies was below 1 in their revenue efficiency index, and fully 50%, half of the sample, was above 2 in their revenue efficiency index. And so the entire industry rather dramatically shifted from failing to deliver scale economies to delivering scale economies on a relatively broad base. And, we think this is exactly what the industry should be doing when capital is properly deployed. The reality is that in the course of the bubble, capital was being misallocated, valuations were too high, capital was chasing growth without really having recognition of underlying earnings fundamentals. And that has now corrected itself, and rather quickly. That correction happened over the period of 2 years, which is probably faster than I would have expected. But it's a testament to the CFOs in the fintech industry being adaptive and reacting well to changing market conditions.
So if we take a step back, what Joel just described sounds like the story of an industry going through full cycle. So first the exuberance and inflated valuations, then what sounds like a painful realization that operating costs were outpacing growth. And then you mentioned, Joel, a pretty remarkable turnaround. So that's actually a nice bridge into my next question. And over to you, Ram. I mean, you did the work updating this analysis with more refreshed data now, looking at 2024 annual reports. Could you please elaborate a bit more on what Joel mentioned about the market correcting itself? What are the top line findings from that updated report?
Yeah, so Joel definitely hit on one of the biggest ones, right, which is this flip in operating efficiency. And I think as we go through the conversation here today, we'll get into some more of the details just naturally throughout the conversation. But the big picture is this: the operating expense growth is slowed across every cohort. which is obviously a sharp turn away from the kind of concept of growth at all costs, the playbook that we saw running only 3 years ago, as Joel was alluding to earlier. What's interesting is that many of the high growth fintechs that we looked at, so the likes of the Affirms, the Toast, the Shopifys of the world, are actually proving that hyper growth is still possible and that efficiency can go alongside that hyper growth. By that, I mean they're all growing gross profit by more than 30% while still keeping their operating expenses under control. All three of those being part of that cohort that Joel described, the 2x or 2.0 index, rather. Even the most recent quarter backs up these findings. So, the trend is holding that capital efficiency is certainly a focus, though there is a twist. I would say that some of the largest global fintechs, so Visa, Corpay, Global Payments as examples, just to name a few, are seeing expenses start to increase, at least at pace, relative to gross profit. But these more mature players that we observe are certainly adjusting their models as they face pressure from smaller, more agile fintech challengers. And I think that's something that we're going to poke on and discuss more as we continue the conversation.
So you mentioned a couple of interesting names there, and I think, Joel, you also mentioned earlier that the report clusters or buckets different fintechs into different categories. And not to spill the beans, but one category that stood out in the research were the SaaS, software as a service, of companies that have software DNA, having expanded into fintech, so the likes of a Shopify and a Toast. So, Joel, could you please elaborate on what stood out to you in the research, looking at these categories and how they perform in terms of efficiency?
Yeah, I mean, first of all, we recognize that, being categorical and putting all these 50 fintechs into buckets is an imperfect exercise, right? Yeah, within any one bucket, you'll have a fair amount of variability, but we're consultants. And so we like to draw boxes around things so that we can reach categorical conclusions. And so we do think that there is some validity in the sort of broader categorical trend lines that you see in our analysis. I think, quite frankly, almost effectively all of the categories improved on the revenue efficiency index. And so I think that's the key conclusion, is really broad-based and dramatic change in the way that fintechs are managed financially. But I think, the category that jumps out, I think most dramatically, is just the SaaS fintech cohort, as we're calling them, that went from kind of the far right of our index, meaning well below 1, to the far left of our index, meaning approaching 2 or higher for a lot of those companies. That's incredible shift in underlying bottom line performance. And I think it's a testament to the profitability and the scalability of the SaaS fintech model. The reason why SaaS plus fintech is so powerful as a business model and also an investment vehicle is because SaaS fintechs, benefit from huge economic advantages in their financial performance. They have very low CAC ratios, very low customer acquisition cost relative to standalone companies. And they have, much greater abilities to cross-sell and upsell and benefit from price insensitivity within their product bundles. So, for example, something like Toast or Shopify is effectively attaching their payment service with zero customer acquisition costs, whereas an independent payment service provider is actually paying quite a lot of customer acquisition costs to sign up that customer. Or similarly, Toast or Shopify can cross-sell a loan at little to no acquisition costs, whereas a lender independently selling that same loan would have a high customer acquisition cost. And so you just see these efficiencies now translating into the bottom line performance of that category. I will note that SaaS tends to account for the revenue somewhat differently than fintechs. And so the way in which they treat COGS tends to be a little bit different, and therefore gross profit tends to be a little bit different. But the underlying conclusions of the analysis are still very much valid, and dramatic shift in bottom line delivery from that category of companies, which we think is a trend that will continue based on the power of the business model.
Yeah, that's interesting. And if you think about acquisition cost of, for example, a small to medium merchant, I recall from research we've done in the past that those can range wildly from a couple of €100 to up to several €1,000 or dollars. And obviously a reasonable acquisition cost needs to add up in terms of the revenue that merchant will generate over its lifetime. So automation and quick seamless sales and onboarding process are really key and something that these SaaS companies do really, really well. And speaking of a couple of other KPIs, I think, Ram, in your updated analysis, you did mention a couple of other interesting KPIs, such as profit margins, cash flow coverage, and leverage. Could you please tell us a bit more about what these KPIs tell us about fintechs today?
Yeah, sure. So at the risk of burying the lead, I think overall we're looking at a financially healthy cohort overall. And so I think there's exceptions to every rule, of course. Some of those have been all over the news and we won't dive into them here. But I would say, based on the data, broadly speaking, tells a pretty positive story. And I would say, the three stats that you called out in your question are the three that we looked at, the three that we chose. We looked at several when sort of developing our insight, but I'll touch on those three quickly. So first, from a net profit margin perspective, overall, these seem to be stabilizing for many of the market leaders that we've mentioned throughout the conversation. It's just proof that fintechs can reach sustainable profits when applying real operating discipline. So for all the reasons that we've discussed, whether it be the stronger model that embedded SaaS with payments can offer, whether it's just overall focus by CFOs on better bottom line discipline, all of that can be applied and still seeing meaningful outcomes, meaningful positive performance as a result. Second is cash flow coverage. So for most companies, it's in pretty good shape. They're generating more than enough operating cash flow to cover, for example, their CapEx. That said, there are some firms showing strain in the most latest fiscal quarter. Again, some of those we've seen in the news, but overall, the cohort very healthy from a cash flow position perspective. Then finally, leverage. And this one probably varies the most. And it's not a surprise given the M&A that we've seen in the industry where debt or leverage can oftentimes be a catalyst for some of those M&A decisions. When we dive into the cohorts a bit more, diversified processors and SaaS providers with embedded payments tend to run with relatively low debt. Again, unsurprising there. But, acquisitive players like a Corpay, who we've seen many times in the news making relatively large acquisitions in the last 2 quarters, tend to lean more into that heavy borrowing. So to circle back, I would say that the ratio analysis really informs the same message that I said, a couple questions ago, which is the sector is really moving away from that growth at all costs mantra and towards a more balanced model, and one that's better equipped to handle some of the macro volatility that we see today and some investor scrutiny. So overall, just a much healthier place than we were at, call it 2.5 years ago.
So really what I'm hearing is that fintechs today are in a much healthier and maybe more disciplined place than just a couple of years back. And those are some really great findings. That makes a good bridge into the future. So Joel and Rom, as we are about to wrap up, let's look into the crystal ball. What predictions or expectations do you have for these public fintechs moving forward? Maybe starting with you, Joel.
Well, I think the most dramatic force of influence on revenue efficiency the coming 5 years, for example, will be AI, because AI has such amazing potential to generate operating efficiencies in areas like technology development, customer servicing, and many others. And AI is inevitably one of those things that you tend to underestimate in the longer term and overestimate in the near term, but we're already seeing evidence of impact on areas like technology development and service automation, among many others, by the way, and we'll cover that in a separate podcast. But we do expect to start seeing the impacts of AI over the next 2 to 3 years. Klarna's IPO underscores that they already see impacts. I think part of that was kind of good preparation and dressing of their IPO, but there's also legitimacy underpinning that, right, that we're seeing in other parts of the industry. And so I think fintech just has incredible potential to yield high gains in productivity, because one of the key constraint really in the industry today is people productivity, because almost all fintechs still have challenges with the growing costs of people, whereas the revenue productivity of people are more disappointing relative to the cost. And so, not that certainly I'm advocating a downsizing of the industry from a people standpoint, but we can get a lot more out of the people that are in the industry with the help of the right AI tools. So I do think we're going to start to see that impact more significantly in the data over the next 2 to 3 years.
Yeah, so we've seen a lot of public activity this year, including several public to private deals in the first half. But that phase seems to be winding down, and more fintechs are now heading down the IPO path. So, of course, we have the Klarna IPO that just happened not too long ago, and we have Chime's IPO from Q2. I think we'll see more fintechs that had been sitting on the sidelines start to go public as the market is, continuing to stabilize. Just recently we learned that T&E platform, the travel and payments fintech Navan, filed for its IPO. SumUp also rumored to be exploring one. Of course, Stripe remains to be the big one that's still primed for its long anticipated IPO. So I think in the public markets, we'll continue to see a lot of investor enthusiasm, whether that's IPO driven or even some interesting valuations on the public to private side, which still seem to be happening throughout the course of the year.
One of the advantages of companies IPOing now, some of which were slated to IPO during the bubble, is that those companies are now IPOing in a healthier state of revenue efficiencies. And so, those same companies, had they IPO'd in early 2022, probably would have been punished by the markets as they figured out how to be more efficient with their bottom lines and with their revenue. But now they've had the benefit of prepping those activities and getting healthier before they enter the public markets. And so it's actually kind of a healthy outcome in hindsight for those companies now that are prepared to IPO over the next year or two.
And I also find it interesting, back to your AI point. I mean, I think even in the public markets, right, investors are starting to reward the AI shift. And so if you take Dave, who's been public now for a few years, I mean, they recently repositioned as an AI-first public fintech, and it's a great example of how AI can help turnarounds in the public market. I mean, I think their stock is up something like 180% year to date, and something like 500% over the last several years. So just showing how AI, as a continued improver of performance, whether on the revenue side or on the cost side, really does categorically change both the performance of a company as well as investor sentiment on the company as well.
With that, Roland, Ram, thank you so much for sharing your insights. I certainly look forward to checking back in when you update the analysis with the 2025 data.
Yeah, excited to publish an update to the analysis. We hope that you all take a moment just to look at the figures and data, because we think it is really compelling and interesting. And we'll be excited to revisit this analysis in the coming couple of years to see if this trend continues or even accelerates on the back of innovations like AI.
And of course, if anybody does have a chance to go through the images and the analysis, and you have any questions or comments, never hesitate to reach out to Joel, myself, Elizabeth, or anybody else at Flagship.
That was it for now. One thing is clear, there is no doubt that the rules of the game have changed, and top-line growth alone is not enough to make investors happy. Growth must include the bottom line, including a story on growing in an efficient way. You have listened to a podcast by Flagship Advisory Partners. Stay tuned for more exciting fintech topics and conversations.